Excellent. Thank you, Becky, for that fantastic introduction. I'm so excited to be here to speak with you all today about things that are always on my mind. So it's always nice to be able to bring other people into the conversation as well. And I hope that you're able to take away some practical tips that maybe you can use to kind of keep yourself informed and figure out how to really interpret and synthesize all of the data that seems to be never ending these days. So I want to kick us off with an essential question that I really want to kind of keep in the back of our minds as we're going through the content today. And when I was thinking about putting together this conversation, I really wanted to identify, what are the key factors influencing the US economy at the start of 2026? And I realized that I probably need much more than 30 minutes to really highlight or to address this thoroughly, but we'll try to get some highlights and at least give you some things that you can think about going forward, and especially as you're reading the news and you start to see headlines standing out to you, what are those factors that are influencing the economy and that might be relevant for your personal or professional situation. Our goals for today's session are to analyze the domestic economic conditions and really take stock of the current environment. So ultimately, I want to look at some data and then discuss potential paths for both monetary and fiscal policy, right? So the policies that are going to influence the trajectory of the economy and understand what are those implications for the domestic situation as well as the global economy more broadly. And I think one topic that's on top of mind for a lot of folks is really to look at the economic effects of tariffs, and in particular in the environment of heightened uncertainty that we find ourselves now. So I've identified some trends that I'd like us to watch, and I want you to think about these as we go through the session today, as well as think of, okay, which of these trends are relevant for you, in particular related to tariffs and uncertainty, labor markets and inflation dynamics, again, things that we're seeing regularly in the news, and we've gotten some recent data over the past week, as well as what a lot of people are talking about in terms of a K-shaped economy. And if this is something that you don't, a phrase that you haven't heard before, I'm hoping to shed some light on that and see why it's important going forward. First, I want to get us started with a backward look of the data that got us to where we are right now. And so looking at labor market data, we're kind of getting a mixed message on the economy. So one thing that I want to note as we start into this analysis here is that all of these data, like I said, are backward looking. So it's telling us what the economy looked like last month. And we can use that to help inform our decisions going forward. But again, we need to understand that this is what it looked like last month. And then we think about what does that mean as the economy is going forward. So the December jobs report that we just received last Friday is one of the first, clean looks at the labor market that we've had in several months. So following the record-long government shutdown during the fall that caused government agencies to really just stop collecting data for about 6 weeks, this led to the delay of the release of many major economic indicators. And so all the data that we're looking at now, we have to proceed cautiously in terms of how we interpret the relevance of the data, because I think we're still kind of catching up in confidence and overall data quality and kind of filling some of the gaps that perhaps we missed. But this is as good a picture as we have right now. And in December, the headline unemployment rate, so the share of the labor force that's looking for work and unable to find it, fell to about 4.4%, bringing us back to the level of September. However, given what we're seeing in terms of the unemployment rate, we also, when you're looking at number of jobs, added about 50,000 new jobs in December, falling short of expectations around 70,000 or so. So really what these data are telling us is that we're starting to see some signs of cooling labor markets, that, job openings, so businesses posting openings, looking for people to hire, these were also down in November considerably from a year before, according to data from the Labor Department. And what a lot of folks are looking at here is that these data suggest what's called a low hire, low fire environment. So this is really where both hiring and layoffs remain low. And this underscores employers' unwillingness to either take on or lay off workers. And this is one thing that, we can see is quite apparent when we look at what that headline unemployment rate may be masking. So the headline unemployment rate looks at the entire labor force, but there is considerable heterogeneity based on different demographic groups. So in particular, I want to highlight the unemployment rate for ages 20 to 24. So these are, recent college grads, young people graduating from high school, associate's degrees, etc., looking for their first job. The unemployment rate for these folks was 8.2%, well above the national average. So here we could think, firms are either waiting to hire or prioritizing seniority and experience, in particular in the age of AI, and given the uncertainty that we see in the environment around us. And so, part of the slowdown in the labor markets might reflect, a decline in the growth of the labor force, partly due to changes in immigration policy, changes in labor force participation. So that would be a supply story where there's fewer workers out there looking to fill these jobs. And we also have a demand story in which businesses may be waiting until we get more clarity on where the economy is going before they decide to engage, in mass hiring. If we expand a little bit more broadly from looking simply at labor markets and look at overall economic activity. So here we can look at real GDP data. So gross domestic product, this is looking at the value of all goods and services produced within the borders of the United States. And the Bureau of Economic Analysis shows that, real GDP exhibited pretty remarkable strength throughout Q2 and Q3 of 2025. So you can see this dip, this negative GDP growth in the first quarter of 2025. This was likely due to a surge in imports in which businesses were looking to kind of front run some of the tariff policy and perhaps import a lot early in the year before the tariff policy was able to take place. But throughout 2025, GDP growth was really solid thanks to strong consumer spending and solid business investment, in particular in artificial intelligence. Productivity, another crucial determinant of long-term sustainability of economic progress, increased at its fastest pace in 2 years in the third quarter, right? So, despite potential cooling and weakness looking at labor market data, the economy from this perspective looks relatively stable. GDP growth, consumption, business profits, productivity, these are trending in the right direction. But what I want to look at is a lot of these numbers, right? So all of our macro data are typically aggregate or average, looking at kind of the entire economy as a whole. And this muddles the story of some of the different demographic groups, as I mentioned before, with the labor markets. But in particular, when we look at incomes across the households across the income distribution. So consumer spending is the largest share of GDP, and according to the data that we looked at before, that was really driving a lot of the growth that we saw in 2025. However, we have a little discrepancy in terms of what I like to think about as soft data versus hard data. So the hard data, those are the actual numbers, right? Like what are people spending? The soft data, this is where there's a psychological component to economic activity, right? So how are people feeling? And how consumers feel really drives how they spend now and into the future. So the University of Michigan puts out a consumer sentiment index. There are other series as well, but what I'm showing you here shows that the consumer sentiment ended 2025 almost as low as it's ever been. So people seem to be worried about the labor market health, right? How stable is my current job? What are my future job prospects? And this is particularly important for those at the lower end of the income distribution. So if we're looking at spending among households across this income distribution, we're really seeing a different experience depending on where you are. So a report from Bank of America showed that consumers in the top third of the income distribution saw their spending rise considerably through November, like the fastest growth in several years, whereas spending among households in the lower end of the income distribution was barely up over the same period. And middle and lower income households are really facing a lot of pressure right now, in particular in terms of affordability, and are focused precisely on, affording basics and essentials for daily needs. So this is that concept of the K-shaped economy that I had mentioned earlier when I was saying, what are some trends to watch going forward? And this is highlighting the fact that economic experiences are not homogeneous. And so the K-shaped situation here is showing that higher income households are those that benefit significantly from asset ownership or employment in thriving sectors such as technology or finance. And what I'm showing in this graph here is since the beginning of 2021, I'm showing the green and the blue lines. These are S&P 500, so stock price growth and home price growth, right? So high income households, those that have access to asset markets, are enjoying gains because asset values tend to keep rising, right? In particular, equities and home prices. However, the downward or flatter line at the bottom, these are real wages, and you can see stagnant growth here. So lower income households or wage dependent workers are struggling because wages for those typical workers rise much more slowly, often lagging inflation. And I mean, visually, we can see this is what we're talking about in terms of that K shape. But what this is capturing is a widening gap between asset workers and asset owners and workers. And so this is capturing that inequality in economic gains and therefore industries or sectors that cater to different portions of the income distribution are going to experience different trajectories going forward, depending on how these two groups either continue to diverge or if we see some convergence. Data that we had been looking at so far is all looking at real activity, right? So number of jobs, what are we producing, how are we spending? But I also want to look at the other side, and we think of this as the nominal factor. So this is inflation, right? So what are price pressures doing, and how affordable are basic living standards for households? So I'm looking at data on the Consumer Price Index. So the Bureau of Labor Statistics puts together a representative basket that the average household buys, right? So they look at, how much are we spending on housing expense, transportation, food, entertainment, etc. So we have all these big categories, and we track that basket of goods over time. And as the price of that basket of goods is changing over time, that gives us a sense of inflation, right? How much are these price pressures changing? And again, the December CPI data actually just came out 2 days ago on Tuesday. And this gives us, again, as close to a complete picture that we can get of the price situation since the government shutdown prevented data collection. We had a gap in the fall, and you can see visually on the graph that there's just an area of missing data. But the snapshot that we got on Tuesday shows that headline CPI, so growth in the price of that basket of goods, was 2.7% year over year. This was consistent with what we saw in November, kind of in line with expectations, right? So 2.7% growth on average of this basket. So one thing to ask ourselves is, okay, who's actually buying this basket? And the inflation situation that you experience could be quite different depending on, one, where you fall in the income distribution, but also where you are geographically. So the BLS, Bureau of Labor Statistics, you can find more disaggregate data if you look at their specific release or going to their website, right? This is on average across the United States. But I know if I were to look at the inflation situation in the Boston area where we are versus, northern Michigan where I'm from, it's going to be dramatically different cost of living. So that price situation, the price pressure situation could be different. Still, when we're setting policy, we try to think, as aggregate as we can. And so, the headline gave us about 2.7%, a little bit higher than what I think policymakers are looking for. However, again, there's a lot of heterogeneity in different components here. So inflation accelerated for stuff like groceries, restaurant meals, housing costs, transportation, right? These were high. And, housing and essential services, this is squeezing incomes, right? They're increasingly spending a lot more of their income on these things that see rising prices. Goods inflation is falling, right? I think, used car and truck prices were also falling. So this is easing a little bit of that pressure. But still, on average, inflation is higher and a little bit stickier, I think, than we would like to see things right now. You can see it's come down since the surge in inflation from the post-pandemic period, but we're still kind of in that last mile where we can't quite get inflation back down to where policymakers would like to see. And so how people feel about inflation and what they expect for the future is just as important for the future path as the actual numbers that we see, right? So these, again, are backward-looking numbers looking at how price pressures changed through December. But inflation expectations are giving us a snapshot of, okay, how do people feel today and where do they think price pressure will be going in the future? So if inflation expectations change, and I think the big threat right now is if inflation expectations rise, this could be due to concerns about tariffs being passed on. The big conversation now is also about threats to Fed independence, which we'll get to a little bit later when I talk about monetary policy, other fiscal pressures. If people today are in a situation where they're expecting inflation to rise, we may see a situation in which some households accelerate purchases, right? I want to buy things now before those high prices kick in. Or under the expectation that things are going to be getting more expensive in the future, I demand a higher wage today, right? So our expectation of inflation can really drive behavior today that causes rising inflation in the future, right? So we can kind of think about, again, how that psychological impact that affects consumer and business behavior is going to affect this trajectory going forward, if more so, perhaps, than the backward-looking hard data that we can observe. I want to pause for a moment and kind of think about now your individual perspectives, right? So observing the world around you, I gave you a very quick snapshot of a lot of main headline indicators that we're watching. And are there, in your personal or professional situation, are there any economic trends that you've identified as being important for your daily work? So it might be things that I have spoken about in the last few moments, could be other, indicators that are important, things that you're seeing regularly in the news. And if we think about those, okay, what have the data been telling me? Are there areas for significant opportunities for growth? What are the potential risks? And the idea is that hopefully we can start to monitor these trends and be aware of when we get new data, be aware of when we have new insights, and use those to make better informed decisions, right? The idea here is to kind of use all information available to us in the most productive way. They're spending a lot of time now looking at the economic situation in terms of just hard data. I want to now shift gears and start talking a little bit about policy. So I'm going to kind of talk in two different realms. One, looking at fiscal policy, which would be government policy, and monetary policy, which is that set by the Federal Reserve, which is the central bank in the United States. So several government policies that are currently in place and the expectation of where they're going in the near term are viewed to be inflationary, right? So the idea is that there's a potential for upward pressure on inflation in an environment now where we already are seeing kind of stickiness in terms of that ability to bring inflation down. So, for example, we could think about tariffs being passed on to consumers as rising prices. So tariffs and trade tension really limit competition or availability of affordable goods for consumers. So there's a chance that we could see an increase in the price of goods due to tariffs that fuel inflation, as some of these costs are being borne by consumers. We didn't see a lot of that surface throughout 2025, and there are a few different hypotheses about why that might be the case. Some of it could be that businesses were in a situation where we didn't really know what the ultimate tariff policy would be, so they kind of held steady rather than passing those costs on to consumers immediately. Part of that could be concerns about reputational damage from increasing prices on consumers, maybe leaving a bad taste in their mouths. But now we're getting to a point where businesses may be quite squeezed, right? They've absorbed a lot of the tariff costs on their own as much as possible, and they might be limited now in terms of flexibility to do that going forward. We also could see that immigration policies could lead to labor shortages, driving up labor costs and inflation. If businesses are out looking, trying to find workers and are unable to do so, then we have a situation in which they're forced to offer higher and higher wages to attract workers. And this could then again drive wage pressures that have an impact on inflation. Also are in a situation looking at extended tax cuts, right? So changes in tax policies that have been put in place. This could really boost domestic demand, spiking inflation, creating a situation with rising fiscal deficits, an increase in debt, as these rising fiscal deficits could drive up borrowing costs for both the government as well as consumers and businesses alike. So there are a lot of government policies that could potentially have inflationary impacts in the near term. Well, we think, okay, in the context of that government policy, we also have monetary policy, which I'm going to spend quite a bit of time on because this is really the area that I spend a lot of my time working in research. But also I think it's something that if you pick up any of the news lately, there are a lot of things in terms of the role of the Federal Reserve, what they're able to do, how they're interpreting and synthesizing the data that are in front of them. And so Chair Jerome Powell in December, during the Federal Open Market Committee, right, so the policymaking body of the Fed, issued a change in policy in December, and he issued the statement saying, okay, we believe monetary policy right now is well positioned to determine how to adjust things in the future based on the data, right? So they're very much focusing on what's called a data-dependent approach, in which they're looking at the data, and they believe that they have the ability to adjust their policy appropriately as new data come in. And this is where it's crucial to have accurate data in order to interpret what is the clear gauge in terms of economic health. And so as the new data come in, we can adjust our outlook, figure out what is the balance of risks. Is the risk more in terms of the cooling labor markets, the data that we saw earlier? Or does the risk tilt more towards the inflationary impact, right? So if we're looking at these policies or other inflationary triggers, and the monetary policymakers are trying to kind of weigh those two concerns and figure out, okay, what is the most appropriate path for us to pursue right now? As we think about that, I do want to take a few minutes to discuss, what are we doing with monetary policy? I think sometimes this can be a tricky concept for people to think about. You hear it in the news a lot. You hear the Fed is doing something, you hear they're changing rates, and we don't necessarily maybe know what is the motivation for doing so, how are they making those decisions. So I want to just break this down for a couple of minutes. And so when we think about the goals of monetary policy, the Federal Reserve has what's called a dual mandate, in which they are squarely focused, right? So this is imposed from Congress on the central bank, and they say they focus on full employment and stable prices, right? So full employment and price stability. The price stability component, the Federal Reserve has implemented that via a 2% inflation target. So if we recall back to the data earlier, inflation is still higher than target. They have a different measure other than the CPI that they like to look at, but still, even in both measures, both cases, it's higher than we would like to see. But the idea is that full prices, full employment, and stable prices, if we can achieve those two goals, these will allow for fostering sustainable economic growth. So central bankers are watching the data as they come in, and they react based on how we deviate from full employment and how we deviate from this inflation target of 2%, which is kind of how they're interpreting this price stability side. The way in which central bankers adjust monetary policy in accordance with the data is by adjusting their target interest rate. So the Federal Reserve's target interest rate is very short term. So this is overnight lending between banks. We do not pay the federal funds rate, right? We don't pay the interest rate that monetary policymakers target, but there is an impact in which the Fed changes their policy target. This adjusts liquidity conditions in the banking system, and it can affect interest rates that are relevant for consumer and business decision making. So the interest rates that typically matter for consumption and investment decisions are much longer term than overnight, right? Think 5, 10, 30 year, right? A lot of us have a 30-year mortgage. We can think about how that's influenced a lot by 10-year treasury rates, right? So these are much longer term. And there are other factors that are going to influence these longer term rates that are relevant for our borrowing decisions. In particular, inflation expectations, things that we talked about before, kind of what do we expect to happen over the life of these assets. There are a lot of other factors, yes, that are relevant, but there is an impact. When the Federal Reserve changes their policy, they change their target rate, and typically the news headline that you would read would say the Fed changes rates, the Fed cuts rates. When they do this, other consumer and business interest rates are affected. So we want to think about, why do changes in interest rates matter for the economy? Right? If we think that the Federal Reserve can actually achieve their goals, it must be the case that when the Fed changes policy, some real economic variables are going to respond. So I think the expectation now is kind of when and by how much will the Fed decrease interest rates in the future. So let's think about, why do interest rates then matter for these different components of GDP, right? Those different components that measure the size and overall activity in the economy. So when we think about the subcategories of GDP, we typically look at consumption, which is most of what we buy, investment, which typically we're thinking about businesses investing in infrastructure or other capital goods, government spending, and net exports. So 3 of these components are sensitive to interest rates: consumption, investment, and net exports. So if we want to think about, okay, how is that? Let's suppose that the Fed were to lower interest rates. If the Fed lowers interest rates, when we think about our consumption decision, when we earn our income, we have a choice to either consume or save. When interest rates are high, that's an incentive to save, right? Because if I park my money, I can earn that interest rate and consume more in the future. When interest rates are lower, that's a disincentive to save, boosting consumption, right? I'm kind of trading off between, do I save for later or do I spend now? Lower interest rates can stimulate consumption because it disincentivizes savings. So there, lower interest rates set on behalf of monetary policymakers can boost consumption spending, which we know is one of the largest components of GDP. We look now at business investment. So business investment, we think, okay, businesses investing in building out their capital stock, building new infrastructure, right, new manufacturing facilities. Lower interest rates allow businesses to borrow more cheaply, right? A lot of that investment expenditure requires businesses to borrow. So if they can borrow more cheaply, that's an incentive to invest more, again, stimulating economic activity, which, as businesses are investing more, what do they need to do? They typically hire more workers, right? That's how they're able to expand. In the third category, looking at net exports, the third interest-sensitive category of GDP, these net exports show us that the value of the dollar is highly sensitive to the level of interest rates in the United States relative to those globally. So lower interest rates in the US typically lead to lower value of the dollar, which can boost our exports. So these three interest-sensitive categories of GDP all respond positively. They all grow, typically, we would expect, when interest rates are lower. So this expectation of future Fed policy, perhaps of lower interest rates in the months to come, kind of this is the idea that we saw through 2025, we were waiting when and by how much will monetary policy change rates? If we look at projections from the FOMC, so the FOMC is the Federal Open Market Committee, they're the policymaking body within the Federal Reserve System, in December, put out their survey of economic projections, which is where policymakers themselves project where interest rates will be at the end of each year into the future, based on, in their view, appropriate monetary policy, given where they expect the trajectory of economic variables to go. Right? So everyone kind of has an idea of, okay, where do I think real GDP is going? Where are labor markets going? Where is inflation going? What is the appropriate policy response to those economic dynamics? And then what I'm plotting here, so the blue line is the actual Fed funds, right? And the green line is our median expectation of those FOMC members, right? So kind of like what they're expecting to see. And so going forward, we're expecting slight reduction in the Fed funds rate, which would be a boost, right? This would be an expansionary effect on economic activity. And I think the original idea going in was that, there was a much bigger expectation of cuts through 2025 and into 2026. Inflation continued to decline, and if the Federal Reserve was able to achieve what they've called a soft landing, which is, can we bring inflation down without harming labor market conditions? If so, that would allow them to continue easing interest rates, which would have that stimulative effect on various types of economic activity. However, following the release of the inflation data last week or earlier this week and kind of mixed jobs report data from last week, we're expecting maybe very little chance of any immediate change in interest rates. The CME Fed Watch, so there's a tool online that you can look at where they're looking at Fed funds futures contracts, essentially trying to figure out like what probability markets are pricing in of where the Fed funds rate is going, right? So we price contract prices today based on where we expect the Fed funds rate to be in the future. And you can look at those and see, okay, what are the odds that markets are pricing in? And they're pricing in, given the data that we've received over the last 7 days, about a 95% chance of them not changing anything at the end of the month. So the new FOMC statement will come out, I believe, on January 28th. And so this kind of puts us in a situation where policymakers are very much wanting to see more data coming in that justifies a change in the policy stance. And I think what this is starting to show us is that we are in an environment that is highly uncertain. So this is probably something, again, a buzzword that seems to be thrown a lot right now is uncertainty and spikes to uncertainty. And, we don't really always know what that means. But when we think about uncertainty, we want to know, or these are talking about the unknown unknowns, right? So risk is something where there are several potential outcomes. We could place a probability on each of those outcomes, make a weighted average of what I would expect to see. Uncertainty is saying we don't necessarily know what those potential outcomes are, and we don't know the associated probability of those different outcomes occurring. And a theme that we have seen throughout 2025 and definitely propelling us into 2026 is that we are in an environment of heightened economic uncertainty. So I grabbed a few different indicators here. One is an economic policy uncertainty index on the left, which is capturing news coverage of things related to economic policy uncertainty. And I really like these kind of measures because it captures that psychological component that if we see these messages regularly in front of us, right, when we see news coverage that frequently is talking about things in the economy and related to policy are uncertain, it can have a significant impact on our behavior and how we think about planning for the future. I'm also showing you the VIX, which is looking at, some interpret this as a fear gauge from stock markets, right? This is how volatile index options are being priced, these expectations here. So you can see maybe a little bit different story, but still a lot of volatility in terms of what we're capturing here. And if we look at that news coverage, right, the messages that are shown to us here, we have heightened uncertainty now that's unlike things we have seen in the past, right? Other than, the pandemic period, you can see these big spikes, but then also early in 2025, and in particular, this is highly associated with uncertainty around tariff policy. If we want to start digging into what are the economic effects of uncertainty, so economists often consider uncertainty about the future as being a very important driver of household, firm, and investor decisions. So when we think about a highly uncertain environment, right? So again, I think earlier I had talked a little bit about that consumer sentiment measure from the University of Michigan. And there I spoke about, okay, if folks are not very confident about future job prospects, about the stability of their current job, we're much less likely to take on big expenditure, right? If I don't know if I'm going to have a job next year, much less likely to take out a new mortgage, to take on a car loan, to spend on luxuries or discretionary spending that may not be necessary. So when we are in an environment of heightened uncertainty, we can see precautionary reductions in spending, both at the consumer and the firm level, especially related to spending that's not easily reversible. So if you think about firms, they may delay investment in hiring because if I invest in infrastructure or I invest in R&D on new product lines, expand my labor force, and it turns out to be happening in a situation in which the economy is weak in the future, that's not something I can just easily turn around. So rather than taking a risk and spending today, they stand pat and wait until we have more clarity on where things are going. We also could think again, like households, if I'm really uncertain about where things are going, I don't take out a car loan where now I have a regular payment every month if I'm uncertain about, what is the stability in my paycheck going forward. So there's a lot of research in this area, some of it which I have done, but I'm certainly not the first to do so. And a lot are finding, that these uncertainty shocks, and when we talk about an uncertainty shock, I'm thinking, okay, there's a heightened uncertainty. And in particular, this is what we've seen, in 2025, especially related to where is policy going, either in the realm of trade policy, or now we're looking a little bit about uncertainty of monetary policy. But what research is finding that these uncertainty shocks can produce a very quick drop in economic activity, right? We just stop spending. Again, we're seeing that low hire, low fire situation with firms. They don't know what to do, so we kind of stand pat until we have more information. We could see a quick rebound in economic activity if we resolve that uncertainty, right? If we start to figure out, okay, this is where policy is going. But that is highly contingent on the situation. So one source of extreme uncertainty right now is specifically looking at trade policy. So the effective tariff rate, so the average effective tariff rate in the United States, this measures revenue from duties imposed on imported goods, right? So they look at kind of the value of those imported goods and see, what share of that is being taken in tariff revenue. And the effective tariff rate on average had generally followed a downward trajectory in the period from the Second World War through the global financial crisis. So in 2008, the average effective tariff rate stood at 1.3%. Today, consumers are facing an average effective tariff rate of 16 to 17%. So when we think about, okay, what are the economic effects of these tariffs, it's very difficult to discern, mainly because we have not seen such large changes in tariff rates for decades. So the rate we're seeing now is the highest since the 1930s, and the pace at which we've seen these increases, the magnitude of the tariff rates right now, and the uncertainty around those tariff rates are really unprecedented in terms of what we've seen in the past. So when we think about, okay, what are the anticipated economic effects, there's a lot of uncertainty there as well. How do we think about what impact this might have on the economy? So I'll try to break down a little bit in terms of what this economic theory might be telling us. I said there's little consensus on what the effect of these tariff shocks will be. I feel like it's every other day I'm reading a new research article where they're finding something a little bit different or taking a different stance in terms of how we examine this situation. But what we can think about as some different hypotheses of what could be the potential outcomes here. So a tariff shock tends to coincide with a highly uncertain economic environment. I've just spent a few minutes now talking about the impact of this economic uncertainty. So that in and of itself could depress activity by lowering consumer and business confidence, if that sort of effect were to surface, firms withhold investment spending until there's more clarity. If these tariff policies have to cause them to, rearrange supply chains, we might be in a situation where firms really want to wait and see what the outcome is going to be before we make such a costly change in behavior. So the short run effects might look like a negative demand shock, right? This is something that compresses activity, unemployment rises, inflation falls. In terms of the impact on labor markets, it really, could go one of two ways, or I'm sure there are others that I'm not thinking of here, but a few different options would depend on those sectors that are particularly more affected than others. So if we think about import-dependent firms, right, these are some firms that need intermediate goods imported from abroad to use those in the manufacture of things here. If they're highly dependent on those imports, they might have to reduce hiring because they've got limited flexibility when their costs are rising. Alternatively, if domestic firms benefit from being protected against foreign competition, maybe they become more profitable and are able to expand. If that's the case, we could in the longer run see some supply side effects. But, many big projects will likely take years to materialize, right? So kind of like readjusting infrastructure in order to move certain manufacturing here takes a lot of time. And the tariff duties would need to be high enough to really incentivize that costly change in behavior for firms to bring that back here. But if we do, in the longer run, see some of that impact, we might create a situation where, yeah, we do see a boost to activity and as we're spending and producing more, that could be a positive driver going forward. But there's really a lot of, a lack of clarity, I think, in terms of what we will see surfacing. And it will take time once, we get a little bit more clarity on where the policy will settle and how that will impact us domestically. We think about, okay, how do we navigate this uncertainty? Again, I want you to kind of think specifically about your individual context, professionally or personally, and reflect on, say the last year, maybe the last even few months, have you or your organization had to change your behavior given recent events, given policy changes, given this heightened level of uncertainty? Which of these indicators resonate most with you in terms of how you plan for the future? And to navigate this uncertainty, really the key thing here is to use that information as productively as possible and use all information that is in front of you. So I would challenge you then to take that and keeping that in mind is to take action. And, I'm calling this, let's create a real-time economic indicators watch list. So it could be things that I've been speaking about today in terms of specific data or other trends, but what things are relevant for your particular decision-making, and translate those macro signals into something that is actionable. We could think about, for example, creating scenario analysis to guide planning, right? So think about, evaluate the risks to baseline scenarios, which would be, okay, given consensus estimates, what are our forecasts? What would be the outcome here? What is the risk to our strategic planning under the baseline? And then best and worst case scenarios, right? And think about how do I need to change my behavior accordingly if one of these other outcomes were to materialize. We can think about establishing like thresholds or trigger points where we would rapidly respond, right? If we see a change in unemployment or a change in the effective tariff rate of X%, then that will prompt an immediate response. And then we can use that to change how we make those strategic plans and how we change our decision-making path going forward. So the key takeaway that I want you to have from this conversation is that really, when we're looking at mixed economic signals, it can be very difficult to make strategic economic decisions given uncertainty makes things very murky. So using a data-driven strategy, which is kind of the goal with this economic indicator watch list, is that you can continuously update, your perspective, manage your risks, and use that to make the most informed decisions going forward.